Hello everyone, this is Przemysław Radomski talking to you on Saturday, October 16th. And in today's short video, I'm going to show you two charts that make the most difference and have the biggest impact on the outlook on the gold market in the following days, weeks, and probably months. And both charts feature gold. The first chart features gold in 2011 to 2013. Most importantly, it features it in early 2013. And the second chart features it now, this year and last year, because the pattern that we saw in gold this year, the very specific movements that I described on the charts, first top, second top, relatively broad top, back and forth decline, they are very similar to what we saw in the past. And the takeaway, well, I marked the analogous price moves, the price extremes on the charts with the same descriptive text bubbles. And right now we are, and by we I mean the gold market is right now in the back and forth decline, and it seems to be in the final part thereof. Why do I think so? Because last week gold moved higher, reached the declining red resistance line based on two previous highs, and then it moved back down before the closing bell, and overall we saw a weekly reversal last week. Gold ended almost $11 higher, but that's not what's particularly important. What is important is that gold reversed on a week-to-week basis. It gave away most of the intra-week rally before the closing bell, that is. And what happened in early 2013? Well, the same thing happened. Gold too moved to the declining red resistance line based on two previous tops. And when it finally did move to this line, it reversed on a weekly basis, and that's what happened also last week. Please note that it happened relatively close to gold's 40-week moving average, which is more or less the same thing as 200-day moving average. Not the same thing, because in case of 200-day moving average, you count daily closing prices. In case of weekly moving average, you take into account weekly closing prices, which is more or less the same thing, but not exactly. But that's not what is important here. What is important here is that the situation is similar also with regard to this moving average. So if the history has been rhyming so well so far, the odds are that it will continue to rhyme also in the near term. At some point, the self-similar pattern will likely break down. All right, the history cannot repeat over and over again to the letter, but it is likely to repeat itself to a considerable degree in the short run. And so what happened in 2013 is likely to happen to a considerable extent once again. And what happened then? Well, gold declined back to its previous lows before taking a breather and then declining in a very volatile manner. So what's likely to happen now? Gold is likely to decline to its previous lows. So probably below 1700, likely to 1670, 1680 or so, then consolidate for a bit and then slide much more. So summing up, even though last week seemed like something bullish, especially initially, it's not really bullish. And there's a good reason for mining stocks' seemingly strong performance on Thursday and Friday. And I'm going to cover that in the full version of Monday's analysis. As a reminder, the Monday analysis will be the flagship analysis for the week, so it's going to be huge. It's going to cover over 40 charts. And if you're not yet a subscriber, I strongly encourage you to subscribe and read this issue. That's one of the more important issues that I posted this year. If you are not yet on our free mailing list, I encourage you to sign up to it. You'll stay up to date with regard to my videos like this one, and you also get 7-day free trial of my premium service. Thank you for watching, and on a final note, please note that whatever I said, what I'm saying in videos in general, is not an investment advice, just my general opinion about the markets. Be sure to read the disclaimer below the video. Have a great weekend or week, depending on where you're watching it. Signing off. Bye-bye.